For new investors, navigating the world of stocks, bonds, and mutual funds can feel overwhelming. Fortunately, there's a simple, effective solution for building a strong, diversified portfolio without needing a finance degree. ETFs and index funds. These investment vehicles have revolutionized personal finance, making it easier than ever for beginners to access broad markets, minimize risk, and steadily build wealth. ETFs, or exchange-traded funds, are baskets of investments like stocks, bonds, or commodities that trade on stock exchanges just like individual stocks. When you buy a share of an ETF, you're essentially buying a tiny piece of every asset inside that fund. Index funds work similarly, but they are typically mutual funds that aim to replicate the performance of a specific market index, such as the S&P 500, by holding the same companies in the same proportions. Both ETFs and index funds are designed to offer instant diversification. Instead of trying to pick individual stocks and hoping they outperform, you're investing across an entire segment of the market. This diversification reduces your exposure to the risk of any single company failing. Even if one company within the fund performs poorly, others may perform well, balancing out your returns and lowering overall volatility. One of the main reasons ETFs and index funds are so popular among beginners is their low cost. Actively managed funds typically charge higher fees because professional managers attempt to beat the market. In contrast, ETFs and index funds are passively managed, simply tracking an index. As a result, they have much lower expense ratios, meaning more of your money stays invested and grows over time. Over decades, the savings from lower fees can significantly boost your total returns. Accessibility is another huge advantage. With many ETFs, you can start investing with just a few dollars through fractional shares. Some brokerage accounts even offer commission-free trading for ETFs, lowering the barriers to entry for everyday investors. Index funds often require slightly higher minimum investments, but many retirement accounts like 401ks offer low-cost index fund options, making them incredibly easy to access for long-term savers. Liquidity is also a factor to consider. ETFs are bought and sold throughout the trading day at market prices, just like stocks, offering flexibility if you want to buy or sell quickly. Index funds, on the other hand, are priced just once at the end of the trading day. While this minor difference rarely matters to long-term investors, it's good to understand how your investments are structured. When it comes to long-term performance, ETFs and index funds have consistently outperformed the majority of actively managed funds over time. Most active managers fail to beat the market after accounting for fees and taxes. Meanwhile, index funds and ETFs that mirror the overall market offer returns that are closely aligned with long-term market averages. Historically, broad market indices like the S&P 500 have returned around 7% annually after inflation, making passive investing a reliable strategy for wealth building. A big psychological advantage of ETFs and index funds is that they take a lot of the emotion and guesswork out of investing. You're not constantly worrying about picking winners, following the latest stock tips, or timing the market. Instead, you adopt a disciplined approach, investing steadily into broad market funds and letting time and compounding returns do the heavy lifting. This method not only improves returns, but also reduces stress and the temptation to make impulsive trading decisions. For maximum diversification, investors often use a mix of ETFs or index funds that cover different asset classes, like domestic stocks, international stocks, and bonds. Some even invest in sector-specific or theme-based ETFs to add a small amount of targeted exposure while maintaining a diversified core portfolio. Target date retirement funds, which automatically adjust asset allocations based on your expected retirement year, often rely heavily on ETFs and index funds to create a balanced, hands-off investment experience. While ETFs and index funds offer many advantages, it's important to understand that they still carry market risk. If the overall market falls, your investments will likely decline in value too. However, because you are diversified across hundreds or even thousands of securities, the impact of any single stock or bond underperforming is minimized. Over time, the market's historical upward trajectory tends to reward patient, diversified investors. Ultimately, ETFs and index funds represent one of the smartest, simplest ways for beginners to enter the world of investing. They offer low costs, instant diversification, ease of use, and strong long-term performance. By focusing on broad, low-cost, passively managed funds, new investors can build a solid financial foundation and let their money grow with confidence. Starting with ETFs and index funds isn't just a beginner move. It's a wise strategy that even the world's most respected investors, including Warren Buffett, recommend for building wealth over the long term. Whether you're saving for retirement, a house, or financial independence, making ETFs and index funds the core of your portfolio could be one of the best financial decisions you ever make.